So, what exactly is the state of the consumer? This earnings period, it truly did depend who you ask. And kind of staying and continuing with the consumer, and it does depend who you ask. Well, the Conference Board Consumer Confidence Index that unexpectedly rose in May, ending 3 straight months of declines as Americans cheered a resilient labor market. But while consumers appear grateful for a healthy labor market, they're still expressing some concern about high prices and interest rates, according to the Confidence Index findings. So, joining me now to discuss the state of the consumer is good friend of the show, Dana Peterson, the Conference Board Chief Economist. Dana, always a pleasure to welcome you on here, and thanks so much for taking the time. We mentioned at the top of this conversation, it truly does depend who you ask, and you're asking all the right people and the consumers out there how they're feeling. So we're asking you, Dana, how does the consumer feel and what is the state of the consumer?
Sure, consumers have mixed feelings right now. As you mentioned, yes, they are pleased that the labor market is still holding up for them. Many of them are working, but they're very unhappy about the level of prices. Prices are too high, especially for food, which makes sense given what you've heard from a number of companies that you reported. And so consumers are also very concerned about the fact that interest rates are very high. So, on the one hand, the basics are expensive, and also big ticket items like homes and cars and even things like cell phones cost a lot more money than what they're used to.
Dana, you mentioned mixed. And I mean, this is a report that, sure, we saw a little bit of relief, at least in that headline number, but the trend, that didn't look too good here. So, what are we expecting to continue to be kind of the outsized thought among consumers going forward as we get into some of the summer months?
Absolutely. When we look at the expectations gauge, which asks consumers what are they thinking about over the next 6 months, it's definitely concern. For the another month, that measure was below 80, which usually typically signals recession. Now, we don't think the U.S. is going into recession, but consumers are concerned that things are going to slow down. Business conditions won't be as great as they are now. Employment options may not be out there, and certainly their incomes are going to remain strained by high inflation and also elevated interest rates. So that's certainly a disconcerting element of the report.
Does this seem like a consumer that is passing on what they typically would spend on, where they would say, hey, no matter what, this summer, we're loading up the family, we're going to travel, maybe we're not flying, maybe we'll drive. And how are they kind of navigating some of those decisions?
Well, the interesting thing is yes, they still are going on vacations, but they're economizing on other types of activities. So, for example, they'll stream rather than take a trip to the movies. They're not interested in going to amusement parks or museums and those kinds of things. And they're also finding that they're having to spend more on essentials, not only food and gasoline, but also healthcare and car insurance. And so all these things are rearranging what consumers are having to allocate their wallets towards.
For consumers that are taking a look at prices and the basket of goods that they may purchase on either cyclical weekly basis or even a monthly basis, and where they're ultimately saying, you know what, we're going to push back on that, we'll trade down or we'll decide not to purchase that for a little bit. How does that ultimately play into when we could see the first interest rate cut?
Sure, absolutely. Well, the economy is already slowing. We saw that in the first quarter. And a lot of it was because consumers really didn't buy goods. And we think that's going to continue to persist. The key thing is services and whether consumers really dial back on that. We're seeing people change the basket of services and are opting for cheaper types of services. So that's probably going to play out over the next few quarters. And so, certainly, if the economy continues to slow. We think it could even grow less than 1% in the second and third quarters. But the labor market stays healthy, meaning unemployment doesn't rise too much. The Fed could look to cut interest rates later this year, maybe at the November and December meetings.
Interesting. All right. Dana Peterson, always a pleasure to get some of your insights. Conference Board Chief Economist. Appreciate you.
So yeah, folks, there you have it. Some information from my beautiful Yahoo Finance team, spreading some information with us, helping us out, explain a little bit about the U.S. economy and what's going on. Yes, yes, yes. How y'all doing today, my beautiful people out there? So welcome back to the channel, the Rafe Pro community. We're going to dive into the latest in the finances the gaming world, man. I look at this stuff as like the gaming world. It's kind of not. It's real life. It's real life events, real life stuff. But to me, it's just kind of a game to bring a little bit of excitement to the table. And today we're going to be talking about a topic that's making waves in the financial world, as you can see, higher interest rates and their massive impact on the U.S. economy. So buckle up because this is crucial for anyone interested in the stock market and the broader economy. Yeah, so what's going on with you guys, man? How y'all been staying afloat out there, maintaining? So that's what it's all about right now in this current phase that we in, is just maintaining, staying afloat, and keeping your thinking caps on. So as of May 30th, 2024, the Federal Reserve has kept interest rates high in the combat to bring down inflation. And just to make a real point, I think the Fed said in one of those videos that they really didn't have no intentions on cutting rates, to be honest, this year. I'm not, 100% sure why everybody started jumping into the phase where rates was gonna get cut this year, and things like that. We could get a rate cut like the lady said at the end of the year, but for the most part, I think we need to just focus on building our portfolios up and time and having good judgment if we should buy a lot or buy a little, because the economy is kind of wavy and higher interest rates is affecting our U.S. companies. Yeah, it says while this strategy is helping to cool down the economy, it's starting to show some painful side effects. So let's break it down. First off, higher interest rates make borrowing more expensive for everyone, from consumers to businesses. For companies, this means higher costs for financing their operations, expanding their businesses, or even just staying afloat. Maintaining is crucial right now. According to recent reports, U.S. companies are staring down a whole of a $380 billion cost that's due because the rates and stuff has went up. You know what I'm saying? They paying a higher cost, and that's a staggering number. You see what I'm saying? So we're gonna go over here and look at Nvidia. So one of these stocks right here that's on everybody's radar is Nvidia. They have broke above that $1,000 range, and they're announcing a 10-for-1 stock split. So, all the companies in play that you got in your portfolio, sometimes if you don't got a certain good company in your portfolio, you could just focus on that company, add that company into your portfolio when certain things start to course, stock splits, hype, and it's just been performing, at a tremendous level. And some people say you missed the Nvidia train, but as soon as they do a stock split, the price is going to come down lower, so that way you won't be able to miss out. You know what I'm saying? So there's one of these plays that we're going to put on your list. And another play that we have is CMG. It reached the all-time high of 3,260, and there's been talk of a 50-to-1 stock split in this one. So this is another company that you should put on your radar. So this is a bar and grill where people go buy burritos, buy food, fast food chain. And the other one, the video, was a AI company for chips, for graphic cards, all that stuff like that. And then we're gonna go to our everyday go-to for goods, which is Walmart. They had a stock split, and the stock has peaked up to a $65.69 all-time year range, and it's down a little bit. So really, you can just focus on these three plays right here, and don't worry too much about all this FUD that's going on in the market. and just, focus on gaining capital and just making sure that you ready if any crisis start to unfold. So right now the situation is being described as a slowly unfolding crisis. And why would we say that? Because the impact of higher interest rate doesn't hit all at once. Basically, it's like a ripple effect, slowly spreading through the economy. Companies that took on debt when rates are lower are now facing much higher interest payments as those debts come due. So this is right here what you should be doing your homework on. If the companies you invested in is taking on a lot of debt, they have to keep a lot of debt to stay afloat, and they just barely getting by. They're not stable. They're not doing as good as they could be, and it could be the market that they're in. It could be the managers that they have. It could be a bunch of certain things like we talking about right here, interest rates. There's a lot of stuff. And you got to look at it like this. Imagine you're running a business and you've planned your budget around a certain level of interest payments, and suddenly those payments skyrocket and you have to pay more. It can force tough decisions, cutting back on investments, slowing down hiring, or even laying off employees. So that's why you see headlines, company laying off laying off employees for this reason, for that reason. You never know what the reason could be. But it also could be an effect of higher interest rates. You know what I'm saying? And the effects are very painful, and they're starting to be felt. And according to experts, this 380 billion figure is not just a one-time hit. It's an ongoing increase in the cost of doing business in America. And it's not just big corporations feeling the squeeze. Small and medium-sized businesses are often hit the hardest as they have less financial flexibility. So that's why you always want to have companies in your portfolio that have already established a place in the sectors that they thrive in, that they do business in. And some of the business owners are saying it's really tough out there right now. They're saying their interest payments go up, and it's eating into their profits, and it's making them have harder choices to stay afloat, or to juggle the daily activities that they go on in their companies. And it's also delaying expansion, and they're having to be very cautious with their spending, and it's just shaking the market up. And that's basically, I believe, what they're really wanting to do: shake things up. Only the strong gonna survive. And it's a challenging environment, you know what I'm saying? But you have to keep the faith, and you have to stay strong. You have to have a game plan to maneuver through these cycles. And it says, and the question to be asked, what does this mean for the stock market and for your investments? In the short term, we might see more volatility as companies adjust to these higher costs. Stock prices could be impacted, especially from heavily indebted companies. But remember, every challenge also has an opportunity to be fulfilled. So if the company ain't just a bad company, but you see the price dropping, you're like, wow, what's going on? This could be an opportunity that the company could be on sale, and that you could add to your positions and build up 125 shares, 1,000 shares, however much you can afford to do. But you have to get some skin in the game, and you need to start building that money up and your capital up, and get your assets going, dividend payments coming in, and just income growing, saving skills, saving up emergency funds, and just allocating on a consistent basis to your investments. And then when you're searching for different companies, really the 3 companies that we just put up is really all you have to do. But just make sure the companies that you're looking for got strong balance sheets, they got low debt, and a solid cash flow. These companies are better positioned to weather the storm, and could even come out stronger on the other side when all this stuff merges into a different phase of the investing cycle. Diversification is always key. Don't put all your eggs in one basket, and sometimes don't spread yourself too thin, which means don't have too many investments on your plate to where you can't keep control and keep a watch out and make sure you stand on point for when you need to buy in, and then your price ranges on certain stuff. So always keep your eye on the charts, stay focused, and we just gonna go ahead and start wrapping this video up, folks. And that was the update for today on our financial world. The impact of higher interest rates is a complex and evolving story, and we'll keep you up to date on as things develop in the economy. Make sure to like, subscribe, and hit that notification bell so you never miss an update. Stay informed, stay invested, and always keep striving to live up to your highest potential. So for the meantime, stay savvy and keep investing. We'll see you on the next one, folks. Peace.